The stock market had its worst drop since 2022. Headlines are screaming recession and people are panicking. But what's actually going on and why is this happening? And more importantly, what do you need to be doing with your money right now? Let's break it down. So, in this video, you're going to be learning 3 specific things. First, why is the market actually crashing or going down? Second, how deep can the drop go or could it go? And finally, third, exactly what you need to do in order to protect and grow your money through it all. If that sounds good, let's keep going. So, why should you listen to me? First, I've helped 453 millionaires build wealth. I became a millionaire myself at 27 with the same strategy, so I practice what I preach. I was a student at Harvard and MIT, and on top of the 11,000 hours I spent studying finance, I also spent 7 years in the industry. So let's get started. Before actually going into the nitty-gritty, I wanted to conduct a poll here in YouTube. So I want to ask you, what do you think the market will do? Will it crash another 20% this year? If you think yes or no or anything in between, let me know. Leave your answer in the comments below. I'd love to know your thoughts. So let's talk about the actual trigger here in the market. So there's really 2 main triggers that we can be looking at. I'm going to zoom in here. So first, we're looking at tariffs, and then we're also looking at market panic. So the question is, and I've gotten this a lot, Fiona, what's actually going on in the market? It's really, there's a lot of tariff threats, right? So for example, these are just 2 tariffs here. Steel, it can go up, or the tariff added 25% increase in steel. Dairy tariffs are up 250%. And the market, of course, is not really liking it right now. And I wanted to draw this seesaw type image here because it's really trying to balance, right, the stock market. So it's trying to balance the stock market with what's going on in the greater economy. And the greater economy in this case includes tariffs. So those are the 2 things that are trying to be balanced out using policy and politics. And it's very hard to do so, as we've seen in recent days and recent weeks. So let's dig into tariffs a little more. And if you are more curious about tariffs and the economics of that, watch my previous video on tariffs. I go into a lot of depth there. So first of all, steel and aluminum. They saw a 25% tariff go into place. And I got this little screenshot here from the White House itself. This is directly from the White House, as you can see here. And it shows that there will be an actual 25% tariff on aluminum and steel. Another tariff, 250%. This here's rumored. This is not yet a fact, as far as I can tell. And this here's a tariff on Canadian dairy products. So it's a threat right now. But it has been about a month since this threat has been publicly announced, so who knows what's actually going to happen, if it's going to be followed through or if it really is just a rumor. There's also a tariff on imported cars. This has recently gone into effect, so 25 kind of seems to be that magic number when it comes to tariffs. We can see this here. Trump announces new 25% tariff on imported cars and car parts. So this means any cars manufacturers outside of the US, they're going to see prices increase. Consumers, you and me, probably don't want to pay more expensive car parts. And so we're likely going to stick to domestic products. At least that is the thought process. So in terms of a globalization, I'm going to write this down here, globalization, it actually hurts, right? So globalization will be hurt with these tariffs. It's designed to pull back all of the companies and manufacturers and goods into the United States. So consumers, you and me, buy more stuff that is manufactured here in the US. Now let's kind of talk about counter. So this here are all the tariffs placed by US, or rumored to be placed by the US, so that's up. And down here are the counter tariffs, right? So these are the tariffs that are placed onto the US by other countries that are trying to counter the US's tariff play, if you will. So this here is a counter tariff from Canada, 25%. We can see here This here is also having to do with car imports. So now Canada is saying, all right, well, we are going to increase the price of cars that are manufactured in the United States. So people in Canada are likely not going to buy cars in the US. And then there's another counter tariff here from China. I'm going to zoom out here a little bit. This here is a 15% counter tariff from China. And this here is against US farmers. So as you can see, all of this is really known as a tit for tat tariff. And it's essentially when countries say, hey, you do this to me, I'm going to do this to you. You do this to me, I'm going to do it right back. An eye for an eye kind of thing. So that's what it's known as, tit for tat. So what does this actually mean for you? So we kind of explored the tariff tension here in a higher level format. And it means three specific things for you, right? So first, we're going to be looking at market uncertainty. We already know this. We've been experiencing this recent market volatility. It's been going down. One day it was down 7%, then it ended only down 2%. What's going on there? So there's a lot of market uncertainty. Businesses slow down hiring. So some businesses have announced freezes. So for example, Shopify actually recently announced a freeze as recent as yesterday even, where they're actually not going to hire, they're going to stop hiring for now until they see how AI can possibly increase the efficacy of their current workers. So this also has to do with AI, right? And a couple of other things. It's not just tariffs. But here's another example. In the midst of all of this uncertainty in the world today, businesses need to be even more cautious, especially with tariffs now being put onto their products if they are manufacturing products, especially outside of the country, or they maybe have a supply chain that's located outside of the country. They're going to be taking this pretty slow and pretty cautiously on top of everything else, like with AI, for instance. And then finally, prices rise. So this is where the consumer, which means you or me, we actually pay, right? So even though there is a tariff placed on the products that are manufactured outside of the US, yes, the price will be higher to the company, and the company will pass that on to a golden platter to people like you and me. So we actually eat the cost. We're the ones that end up really paying, not so much the company. Again, if you're interested in more details, check out my previous video for an in-depth economic analysis of that. So the market, as we already realized, really does not like uncertainty. I'm going to put a little sad face here. The market doesn't like uncertainty. And this here is as of early this morning, so very, very recent picture this morning being early April. And we can see the S&P 500 on a year-to-date basis. So this means from January 1st all the way to April 2025. The market has actually been down 13%. Now, a lot of people are worried and scared, and I hear it all the time. Oh my gosh, we're down 13%. That's worse than a correction, which is true, and we'll get into that in a second. But in correction, for those of you who are wondering, correction is when a market goes down about 10%. And we're worse than 10% on a year-to-date basis. But that's only year to date. If you look at it from a 5-year or on a maximum view scale, it's actually not bad. It turns from red, it goes into green, right? So the market is not that bad if you zoom out, if you stay focused on a year to date, which to be fair is more than a quarter. So it's been over a quarter and the markets aren't looking that great. They don't like tariffs and a lot of the other uncertainty too. It's not looking too hot, but keep watching because we are going to go into that and we're going to talk about how you can manage your money. So debt and interest rates. This here is another huge topic that has been going on in the United States and around the world, specifically the United States' debt level. So I drew a very quick chart here of the current spending of the US. And take a look here. You see two bars, right? We see bar 1, we see bar 2. This year's US defense spending, it's about $900 billion, which is a lot, right? Big sticker price. But then we see interest payments, right? Just interest payments. So think to your credit card, for example. And on your credit card, you have an interest rate probably of about 24%. That's typically the average. Now this year, this $1 trillion, which is more than U.S. defense spending, right? It's a lot more. That exceeds by $100 billion U.S. defense spending, just in interest payments alone, not even the principal. That is pretty shocking. So that's a quick picture of what's happening in the U.S. in terms of spending. And just got some cool screenshots here for you as well to see for the first time. This is the first time it's happened. I should have said that too. The U.S. is spending more on debt interest than on defense. So make of that what you will. What's facing us next? What could happen? Does the U.S. want a recession to manage its debt? And that is what a lot of analysts are starting to say and think on Wall Street. So I'll go into a little bit more depth here, but essentially what they're saying is because, I'm going to scroll back up, because there is so much debt, right? This year's just the interest, not even the principal. So what you actually owe, it's just interest payments. Because there is such a massive amount of debt in the United States, they don't want to pay so much in interest. Now, interest rates, as we know from our credit card example, are variable, meaning they go up and they go down, and they go up, right? They're not fixed. So the question here that this article is posing, it's asking, is a potential recession or a market correction manufactured? In other words, is this man-made by policies, by government, in order for the Fed to react? So the Federal Reserve, right? The Fed Reserve to react, that then would lower interest rates, which would then lower the interest spending of the U.S. And that is the question. That is what this article here is asking. Is this recession or is this correction? We don't know if it's a recession yet. Is this potentially manufactured? And that's the big question here. So to give you a better view, this image is taken from usdebtclock.org. It literally increases every single second. So I just took a screenshot here again as of this morning in early April 2025. Right now, the total national debt is about $36 trillion, which is quite significant. And this chart breaks it down. And it just, it looks at U.S. national debt, and you look at debt per citizen. I mean, I thought it was pretty interesting. Check it out on your own time if you want. Again, these numbers, they increase every single second because of the interest. And that's what this entire article is about. The interest is causing this debt also to increase so substantially. So the U.S. national debt over the last 100 years, not surprisingly, has really taken off. Especially, I think 2020 is probably somewhere here. I'm just going to put 20. That's really when it also took off. Again, we're talking stimulus checks. We're talking the Paycheck Protection Program, which wasn't that effective, and a couple of other programs. So COVID certainly helped with that. So a lot of debt over the last couple of years. And the interest, again, does not help. And here you can see, this here's really getting down to the nitty gritty of it. The interest rate, I want to take you through the era of interest rates from 2015 to 2024. Now, there's two pieces to this chart. The first piece is this here, which shows the interest rate, okay? And then the second piece of this chart shows the debt level. So what you can see is there's a spread, meaning as interest rates increase, right? So we have interest rates ticking higher, the debt level also increases. So this here is getting worse, or like you're in negative territory, kind of. You're in the red. That's what debt means. So as the spread gets bigger and bigger, that means you have more debt. And it makes sense, right? If you do a quick logic check, it makes sense. If interest rates increase and you can't pay it, well, then you have more debt. Why? Because the interest already adds to your existing debt. And that's exactly why people are thinking maybe this potential market correction or potential recession, if it turns into one, could be manufactured in order, because if you take a look, when there are recessions, so for example, or corrections in 2020, whenever the economy is not doing that well, guess what? Interest rates, generally speaking, tick down. What does that mean for the United States? If interest rates tick down, that means less payment on the debt, and you could potentially pay off that debt at a faster rate. That's the thought process. So a really scary part, I thought at least, was 70% of this $9.2 trillion debt needs to be refinanced by mid-2025. And we're talking June 2025. So if it's April, as of the time of this video, we have 2 months to figure this out. How is this debt going to be refinanced? And can it be refinanced at a lower rate? That is the burning question. So what do markets have everything to do with this? I've kind of foreshadowed already the thought process here, but I'm going to put it on paper for you. First, rising interest rates make our debt really expensive. Again, we walked through the logic there and it makes sense. And second, a market crash might actually help by forcing rates back down. So this is where the Fed Reserve comes into play. Okay, so how bad could this actually get? This might be the next burning question in your mind. Bad being the market, right? How bad could the markets get here? And so there's some terms I want you to know. We briefly talked about it, correction. So we've already experienced this recently, right? So we experienced this. Why? Because the market went down 10%. Right now, it's about 13% year to date. So the corrections on average, they last about 71 days. So that's about what? 2.5 months, maybe 3 months, something like that. And it occurs every 16 months. So what am I trying to tell you with this correction terminology? I'm going to write this down because I really want to make sure everyone understands that corrections are normal. They are completely normal. Corrections are part of the cycle, the economic ecosystem. It's just what happens in the economy. So the fact that it's down 13% really shouldn't scare you. It's just part of the regular market ups and market downs. Now, bear markets, zooming back in here, this is when the market decreases by 20% or more. And generally, on average, drops are about 33.2%. So the market goes down by about 33% or more. And bear markets, they last about a year. So that's generally how long they last. Some bear markets, they recover really fast. Others take much longer to recover. So quick picture there. And then finally, market collapse. Don't worry. I don't think, at least given the current indicators, it does not look like we're at that point yet. Who knows? But right now, it doesn't seem like it. But market collapses is when the market drops by 40% or more. Very rare, about three times every 120 years. So, probably not going to happen, but who knows? So let's take a look. I wanted to zoom in more on corrections because we just experienced a correction. And again, nothing to really worry about because corrections are very common. Again, once every 16 months or so. So corrections, I want you to take a look here, specifically at these two graphs. Wherever you see a blue square is when a year when the market saw a 5% or more decline. And take a look, you see them in almost every single year, right? So they're pretty common. And now take a look. So this 10% or more decline, this is correction territory. Okay, that's exactly what we spoke about before. And again, wherever you see one of these boxes, these teal boxes, that means the market correction occurred in that year. And while much less than the 5% decline, this is still pretty common. You can see that, right? Again, it's nothing out of the ordinary. People don't like to see it. Of course, I don't like seeing it either on my portfolio, but I also know I'm invested for the long term, so I'm not really too concerned. Another thing I want you to understand is this chart. This chart shows you three things. First, it shows you the green bar, which is the annual return, which means at the end of the year, how much did the market end? Like on average, how much did the market return? Then you have these green squares. I'm going to zoom in. So these are little green squares, and this is the highest peak, right? So this is the peak in that year in terms of return. And then you have these red squares, which is the lowest point when it comes to that year in returns. So right off the bat, what do you see here in this chart? Well, I see a couple of things. First of all, I see that in almost every year, the lowest point of the market was below 0% return. It was negative at some point, almost all the time, maybe every single time. It looks like it's pretty much every year, even though the return in the year that the return was positive, which has been much more often than not, there still were negative points in the market. So again, don't be concerned. This is the biggest drop, and the biggest drop, I mean, look at this year, for instance, right here. The biggest drop was over negative 30%, but the market still finished in the positive territory, and the highest high was up 70%. Talk about volatility, right? That's just part of it. It's part of the cycle. So if, again, history doesn't necessarily mean it's going to happen again, but at least the present generally rhymes with history. So also, if you don't, if you still need more proof, Scott Bessent, the Treasury Secretary, he also mentioned that corrections are healthy and normal. It's just part of it. Jim Cramer does not agree with it. So again, you have different types of viewpoints out there. Take this information as you will. I think it's good to understand opinions, but more so, it's important to look at the data and let the data speak for itself. Okay, so what actually does all of this mean? We just did a quite heavy analysis. What does this mean for you? Corrections are normal. Bear markets can be very painful, especially if you're watching your money go down every single day, every hour. Don't do that. I highly recommend against it. So what should you actually do? Well, you got two options, right? First one, you can react emotionally and you panic. I hope you like my panic button. And you say, oh my gosh, I'm going to sell everything. Panic. The second option is you can act rationally. You can think through it logically, knowing the data and the information that we just talked about. So there's something called the dollar cost averaging strategy, also known as the DCA strategy, where regardless, this green line here, right, this is the market, regardless of what the market is doing, whether it's up or down 13% like it is today, or at least year to date, it doesn't matter. You just invest the same amount of money for dollar cost averaging every single day until you decide to retire. There's different types of strategies also. There's something called lump sum investing. There's a couple of other investing strategies, but the DCA strategy I like because it is out of sight and it's out of mind. Why? Because it's automatic. You set your dollar cost averaging strategy. You don't think about it twice. You predetermine which investment it's supposed to go into. You predetermine the amount it should be going into. You predetermine the frequency. So like every week, every day, every hour. It's probably not an option, but you get my point. The point is you don't have to follow the markets. Dollar cost averaging just keeps investing regardless what's going on in the markets. And that is probably one of the best ways to build wealth without being impacted by the market. Now, what not to do? I typically include this image a lot in a lot of my presentations and seminars because I think it's really powerful. It's simple, but it brings the point home. Specifically, if you look at this line represents the market, and you have greed buy. So typically when the market goes up, people become greedy and they're like, oh my God, I have FOMO, right? I have the fear of missing out. They want to buy the market because everything's going well. And then when the market goes down, people are worried. They see their account numbers drop like I am today. And yeah, they're worried. And they say, I can't stand this. I'm emotional. I need to sell. This is the perfect strategy to get broke. And we don't want that. So you cannot control the market. It's just, unfortunately, you can't unless you own billions and billions of dollars and you make several block trades and then you influence the market. Yeah, maybe. But assuming that you and I are very alike, we are not those who are controlling the market. But you can control your reactions to what the market is doing. You can control your emotional or rational response. So most investors, believe it or not, they actually lose money in the market. So of course we already really analyzed this image. But surprisingly, and this also shocked me when I saw the statistic, the average investor only has a 2.1% return in the market, while the S&P 500 has an 8.2% return, and this year's between 1996 to 2015. You can see it here, the average investor at 2.1%, and then the S&P 500 during the same time frame at about 8.2%. Why does the average investor have this poor return versus if they just literally invested their money in the S&P 500 and just let it go and keep investing, or don't invest but just keep your money invested? And versus the average investor. The average investor oftentimes does what we know as active investing. So they choose some stocks that do well on a hot tip or based on what they read in the media, and then they're in it for a couple of months, then they get worried, they follow this pattern right here, they see it's going down, then they sell, and they repeat the cycle. That's exactly why the average investor, unfortunately, does not follow the same returns as the S&P 500. The psychology of market crashes. So oftentimes I see even my clients when I worked with them, they were wondering, like, where should I buy? Should I wait? They're too scared to buy because it's going lower. Then the market bottoms out and no one knows when it actually bottoms out. And then it goes back up, right? It bounces back up, and then people regret not buying. So most generations think that this time is different, but it's not. It's not. It's typically the same thing. History rhymes often. So the bottom line here is that habits, your habits when it comes to investing, matter so much more than headlines out there in the media. You can do right now, with all of this tumultuous going on, everything's going on in the world, you can focus on what you can control. Again, your emotions, how you invest, right? So 20% of your income, as an example, goes into investing. 30% goes into wants. 50% goes into what you need, like your car insurance, like groceries, like fuel, stuff like that. You can set a budget like this, for instance. You can cut expenses. So if times are getting tough, maybe you can decrease your wants, your want category spending. Okay, so maybe you don't go out to that restaurant this week, and instead you put that money that you would have spent in the restaurant and move it into the investing bucket. So now you invest when the market is going down, meaning stocks are cheap. Which brings us to our third point. You buy the dip. When the market goes down, the assets are cheap. They go on sale, meaning you get them for a cheaper price. And chances are the market's going to rebound at some point. At least it has always done that in history. And then, of course, invest like the market never crashes. Just keep going. Do not allow your emotions or your fear of the market keeping going down change your investing behavior. Just keep investing. And then also, of course, build your emergency fund so you don't have credit card debt. So, we know that credit card debt can be very painful. We've seen the interest rates. We've analyzed that. It's not a good way to spend your money. So make sure that you do have an emergency fund so you don't have that credit card debt. The most important thing, as I always say, is start building wealth right now. And if you found this video helpful, please like and share to help others. I bet others will appreciate it, as will I. Subscribe to my YouTube channel, and that is _MMW for more cool insights. And then I would love it if you join my newsletter for more exclusive tips. The link is in the description below. Your bank accounts will thank you later. Thanks, guys.